Thanks so much for joining us today, and welcome into America's Retirement Headquarters, home of the Retirement Guys formula, America's Medicare Associates with Nolan Baker and Chaz Price this week. My name is Chris Swan. Here's how you reach out to the show, 419-794-3030. If you have questions about things we talk about this week, or you just want to know more about your retirement, that's the number to get in touch with America's Retirement Headquarters, 419-794-3030, online, arhq.com. On today's show, we're going to talk about some of the common estate planning mistakes, how healthcare expenses impact your retirement, and after an abysmal 2022, is the 60-40 portfolio back on track in 2023? All this and more. But first, let me check in with the guys. Chaz, Nolan, glad to be with you. How are you doing today?
Doing well. Glad to be back on the show. Thanks for having me. Nice weather we've been having recently. So,
yeah, it is great. Nice weather is coming up. March Madness right around the corner. So it'll be here before we know it.
Absolutely. And, some people say it's the most wonderful time of the year. And, if they could say the same thing when it comes to it being tax season, that's debatable. But there's a lot of things that can go and impact beyond just taxes that you owe in 2022. A lot of things could affect your retirement prospects. So let's go and talk about some of these right now. The Federal Reserve has signaled it might raise interest rates at least 2 more times before it considers scaling back and pausing on that. Economist Jeremy Siegel tells Fox Business he actually thinks that's a mistake.
Jay Powell already says the biggest force of monetary policy works with a lag. It's sometimes 6 months, 9 months, 12 months. So this tremendous tightening, one of the greatest in history, its effects have not been felt. I would prefer that they stop now. I think there's enough evidence that the prices are down, that they could pause and wait and see the course. I think continued increases will increase the risk of a recession in the second half of this year.
So he's saying that it might take a year for us to feel the full effects here. If that is the case, I think the question is this: are stocks or bonds better in times of rising interest rates?
Well, we have had really kind of aggressive interest rate rising in the past year or so, and it does take time, I think, for things to settle in. I think if you look at the housing market as a perfect example, we had such a hot housing market. Now that mortgage rates are up dramatically, you're starting to see maybe it's slowing down with the number of buyers that are out there, but it's still kind of a hot market. It does take, I think, some time for things to settle in a little bit.
I would agree. I mean, I agree totally with the segment piece there earlier in that it does take some time. I mean, the Fed's been rising rates for the past, 9 to 10 months now. Mm-hmm. And, the reality is that when you think about major expenses like rent, you may not know that you're getting an increase for the next 12 months or so because you have a lease or some sort of employment contract. If you're going to go and ask for your boss for more income, you may not be able to do so for another 12 months or so. So I agree. Jeremy Siegel is spot on in the fact that they may be overdoing the Fed rate tightening. And my other point that I wanted to make also was just that the Fed has not been traditionally real great at navigating us out of or avoiding financial crises in the past. I mean, Ben Bernanke in 2006, the subprime mortgage crisis. The Chairman Powell said that we totally underestimated inflation and the transientness of it. And so, I mean, my takeaway from that piece is that you can't rely on the government to provide for your future.
Yeah, I would agree. And, they oftentimes get it wrong. And they even admitted just recently when they started it that they didn't realize inflation was going to get so out of control. And, and so that's what it leaves the investor wondering, are stocks or bonds better when interest rates rise? And so if you look at it like last year in 2022, both stocks and bonds had really a terrible year. In fact, it was probably one of the worst years on record for a long time for the traditional 60-40 mix because both categories went down. Early on when interest rates go up, bond prices have historically gone down, and that's exactly what we saw last year. So near term, there still could be some risk with rising interest rates, the impact on how it's going to have for the bond market. The stock market also has some fluctuations because of the chain reaction that can happen with dramatic increases when interest rates go up. Really what happens is you have the cost of borrowing is going to get higher. When the economy is growing too quickly, central banks are going to raise the interest rates to slow down and try to fight off inflation. And when the economy is slow, then in more of a recessionary environment, that's where central banks are going to look to lower interest rates and encourage borrowing and stimulate economic growth. So here we have when interest rates go up too fast, it can cause several issues and factors for the stock market. First, higher interest makes it more expensive for companies to borrow money. That can lead to decreased investment and slower growth. That's why you saw last year a lot of the growth-oriented companies were some of the most impacted companies out there. This can cause companies to become less profitable. It can lead to a decrease in stock prices. Additionally, when you have higher interest rates, it can lead to decreased consumer spending. So as you talk about, if somebody's mortgage gets higher, or if the cost of goods get higher, their credit card rates get higher, interest goes higher, things get more expensive, they may borrow less. It's going to cause a decrease in sales and profits of companies that rely on that consumer spending. This in turn can cause a decrease in stock price as investors become less optimistic about the company's future. So you got to know what you own. Are the companies that you're invested into, are they really dependent upon that strong consumer spending? And have you thought through the fact of what if consumer spending slows down? Furthermore, higher interest rates can also make bonds more attractive to investors. We've been talking about on the radio show different type of bonds that are out there. One great example is the fact that government I bonds are at the highest rate that I've seen in decades.
Yeah.
If you look at a lot of the other traditional fixed income rates that are out there, they're back up to decade level highs. So people that are looking to try to take advantage of the interest rate rise, as the yield on the bond rises, making them really more appealing to investors for stable returns, looking for more income. As a result, some investors are going to shift their money away from stocks, move it into bonds, and that can also lend towards a decrease in the appetite for people buying stocks. And a potential decrease in stock price. And, last, I would say with higher interest rates, it can cause a decrease in economic growth. It's going to lead to decrease in corporate earnings, decrease in stock price. As interest rates rise, it becomes more difficult for businesses to borrow money, lending to a decrease in investment against slower growth, causes a decrease in consumer spending. So, really, I would say in my conclusion, when interest rates go up too fast, it can have a significant impact on the stock market. Higher interest rates can also lead to decreased investments, decreased consumer spending, decreased economic growth, all of which can cause a decrease in potential stock prices. As such, investors really need to monitor interest rates. You need to know what you own. I think the solution here is to have an independent portfolio analysis done. Have somebody like us take a look at what you own. We can slice and dice the different investments that you have, talking to you about which companies may be bigger impacted by less consumer demand, or other companies or bonds that could pay higher interest rates than what you own right now.
Yeah, I'd agree. And there's just so much that we don't know about monetary policy, which is, back to Jeremy Siegel's point about why there's such a risk that if you increase so quickly that you can cause some significant harm to the economy, especially in the fact you kind of touched on it too, in that much of the economy is based on investors' expectations and what their perception is. And I loved at our last event that we did, I think you did that at Red Lobster, and you just kind of did a little social experiment where we asked how many people think the market's going to go down 20% in the next 6 months. A lot of hands went into the air, and then we asked, well, how many people think the market's going up 20% in the next 6 months? And there weren't a whole lot there. So it's an auction, like you say. And so if people expect there to be recession, if people expect there to be economic downturn, there probably is going to be one, because they're going to act that way. And so that's, again, just kind of bringing it back to the rising interest rates, why it's so much of a risk is that when they anchor at that 2%, they've talked about inflation needs to be at 2% before we stop. There's really no way for them to control that, because it's the investors' expectations. And so bonds are certainly benefiting from that aggressive rising interest rate. We talk about it a lot. I don't think I've seen bond rates in the last 20 years like this. There's going to be a time, though, when I think it's going to be an optimal plan to buy some longer-term bonds, but probably not now. I mean, I think we still expect to see a lot of interest rate increases in the next 6 to 12 months. And so, as you pointed out, Nolan, bonds will go down. But there will come a time when I think it makes a lot of sense for investors to, maybe move into a 10 or 20-year sort of bond. Corporate rates are close to 5 and 6%. You can even get treasuries for 3 and 4%. Compared to the average dividend yield right now in the S&P, it's about 1.7. So there's just not a whole lot of reason in this type of environment to be taking the added risk with the stocks when there's such a more attractive, maybe less risky alternative.
We've used this analogy before. The Fed continuing to raise interest rates is kind of akin to trying to get a pot of water to boil. And so you keep turning up the heat and you keep moving it without really waiting for the effects of that last increase you had. And so they keep rising interest rates, and they said they're going to cool down a little bit, but we haven't really seen the ramifications of it yet. And it could very well boil over sooner rather than later. The good news is we're not there yet. There are things you can do right now. There are strategies, moves, and certainly things where the higher interest rates can be more favorable. And to explore some of these options, like Chaz and Nolan were just talking about, give a call, schedule a time to speak with the team at America's Retirement Headquarters. Real easy to get in touch with. 419-794-3030 is the phone number, 419-794-3030. You can always schedule a time and check out the upcoming events they've got going on throughout the next couple months at arhq.com.